This video will discuss owner compensation strategies for limited liability companies. As a business owner, you have 4 different choice of entity options. Each of these options have different pros and cons and need to be weighed carefully when choosing your entity structure. Generally, an entity taxed as a sole proprietorship is the most common for new businesses just starting out. A sole proprietor is someone who owns an unincorporated business that has just one owner. It is the easiest type of business to establish and dismantle due to lack of government involvement, making them popular with small business owners and contractors. A partnership is a formal arrangement by 2 or more owners to manage and operate a business and share in its profits. An entity taxed as a partnership is best for owning assets. An entity taxed as a S-Corp is best for earning ordinary income for trade or business. And an entity taxed as a C-Corp is best for income shifting and establishing employee benefit programs. Sadly, most business owners and their advisors select their choice of tax entity once and then they forget it. There's no single best entity for all businesses. In some cases, your best entity option will change over time. In other cases, you'll want multiple entities to take advantage of multiple tax opportunities. Now, many businesses are organized as limited liability companies or LLCs. It's important to remember that an LLC is a state-level entity classification. However, it's not a tax classification. A single-member LLC will be disregarded for tax purposes and thus taxed as a sole proprietorship, unless it elects to be taxed as an S-Corp or a C-Corp. A multi-member LLC will be taxed as a partnership unless it elects to be taxed as an S-Corp or a C-Corp. If you're taxed as a sole proprietor, there's no separate tax form for your business. You'll handle everything on your personal return. You'll report your income and expenses on Schedule C. You'll pay income tax on your net income, and you'll also pay employment taxes on that income. That means 15.3% up to the Social Security wage base, which for 2021 is $142,800, plus 2.9% on anything above that amount. You may also pay an additional Medicare tax on earned income above a certain limit. On the bright side, proprietorship income qualifies for the qualified business income deduction. Some accountants dismiss the self-employment tax, especially once you exceed that Social Security wage base, but it adds up fast. In our example, we have an owner netting $80,000 and paying $11,304 in self-employment tax, and that does not consider their regular income tax. As a general rule, we find that being taxed as a sole proprietor is the most tax-efficient structure for a business generating less than $50,000 in net income per year. Does it make sense for sole proprietors and partners to pay employment tax on all their business income? Not really, and here's why. Owning a business rewards you in 2 ways. You get paid for the work you do for the business, the same as if you were working for someone else. To that extent, it makes sense you pay employment tax on that income. But you also get rewarded for your ownership of the business, and plenty of business income escapes employment tax. Let's say you own stock in a publicly traded company or any other company that pays a dividend. You'll pay income tax on it, and you may also pay net investment income tax on it if your income exceeds a certain dollar amount. But you won't pay employment taxes on that income because you aren't personally working to earn it. This is true even if you actually work for that company while you own that stock. You pay employment tax on the portion of your income that represents your salary, but not the portion that represents return on your investment. The S-Corp gives you the same benefit. You'll split your income into 2 parts. You'll get a salary reported on Form W-2 just like any other employer, and you'll get the net income just like with a proprietorship or a partnership on Form K-1. You'll pay employment tax on your salary just as if you were working for any other employment, but, and here's where the magic happens, you'll avoid employment tax entirely on the amount that passes through to you as net income on Form K-1. S Corp passes through income qualifies for the qualified business income deduction. It isn't subject to the 3.8% net investment income tax so long as you are materially participating in the business. Let's take a quick look at some numbers to see what sort of savings we can create. A minute ago, we looked at a business owner earning $80,000 as a sole proprietor, paying $11,304 in self-employment taxes. If we establish an S Corp or cause an existing LLC tax as a sole proprietor to make an S election and pay a $40,000 a year salary, we'll save $5,184 in employment taxes. This is especially valuable because we're simply not eliminating a tax. We're not asking you to put $5,000 into a retirement plan and then deduct it and save 24% or 32% or even 37%, but locking it away. We're not asking you to spend $5,000 on new equipment and then deduct it. We're simply avoiding that $5,184 in self-employment tax entirely. A business who is generating between $50,000 and $250,000 a year in net income should consider making an S election to be taxed as an S Corp. Now let's look at the fine print, because you're probably already wondering, why not pay zero salary or a ridiculously low amount like $1,000 a year? Well, the IRS has rules that require you to pay yourself a reasonable salary for the work you do as an employee for the corporation. While it's not always easy to determine what reasonable compensation is, several court cases have made some decisions on that requirement. Here are 9 factors that the court have considered: training and experience, duties and responsibilities, time and effort devoted to the business, dividend history, payments to non-shareholder employees, timing and manner of paying bonuses to key people, payment by comparable businesses for similar services, compensation agreements, and the use of a formula to determine compensation. Using an S Corp to minimize employment tax is a well-established mainstream planning strategy. We have tools that can help determine what a reasonable salary for services provided would be. Once a business starts generating more than $250,000 a year in net income, it is possible that a C corporation might be a better taxation vehicle. Reasons to consider a C corporation include establishing employee benefit plans, needing venture capital, maybe you intend to take the company public, and finally, the 2017 Tax Cut and Jobs Act significantly dropped the C corporation income tax rates from 35% to 21%. This lower corporate tax rate can make the C corporation particularly attractive for some businesses. This has been a very quick overview of compensation strategies for business owners. If you have any questions about anything in this video, please feel free to reach out to us.